Hey folks, Dan Frio here with your closing bell for October 15th, 2024. I'm going to do something a little bit different tonight. I'm not going to go over where the stock market ended. I want to basically just take a look at the overall economy in the United States. And we're just going to look at the key elements that most economists look like. And we're going to give our economy a thumbs up or a thumbs down. Let's start with that. So first thing we want to do is go over and right through here, just the basic information of our economy right now. We start all the way over to the left. There is the federal funds rate. That's the interest rate, basically the Federal Reserve pegs in the economy on short-term borrowing of money, like credit cards and car loans and things like that. So that rate right now is between 4.75 and 5. Okay. Then we have the inflation rate right now. That's the PCE indicator. It's at 2.2%. We have unemployment right now, the unemployment rate at 4%. We have GDP, the production in our country at 3%. So if you look at these in general, the first thing I always tell you guys is, how do we monitor this to see if things are good or not? We have to look at history. So for example, is inflation at 2.2 good, bad? What is it? Well, we look back and just not too long ago, we had inflation right through here. It was 9%. Okay, so being at 2% right now, fantastic. It is at 9% up there somewhere. But so you go down through here, now it's at 2.2%. Well, we're on a good trajectory. Okay, the next thing is the unemployment rate. We're at 4.1. Okay, over time, here's where it's been over the last 10 years or so. Over time, it's usually under 5%. We've seen that over the last, let's go back to a couple centuries or a couple decades now. Okay, so that's that. And then GDP, you can see that as well, and it's on a good rampage up. Okay, so let's get over to this. Now let's see, is the federal funds rate too high right now? This is what a lot of people their contentions are, saying, well, the Federal Reserve has rates too high because the economy is basically back to, let's say, normal, or as normal as we can possibly be with all this stuff going on. So let's see, is these rates that we're seeing right now today high, really high, normal? Well, let's click this and see what it looks like. Okay, so here's where the federal funds rate has done over the last, well, let's go back all the way back to, what do we see? Let's say 2010, say. Okay, federal funds rate, it's almost zero. Look at 0.25, 0.25, 0.25, and it skyrocketed up through here. This is back in 2019, skyrocketed all the way up to 2.25%. Okay, and then it came all the way back down. That was that head fake that we had back then, that inflation was out of, calmed and everything else. And then what all of a sudden would happen? Here's what happened. After COVID and everything skyrocketed in prices, Federal Reserve came in and said, we have to calm inflation. So we're going to keep ratcheting up interest rates to levels we haven't seen in years and years and years and years. So this is now the reason why a lot of people are saying, well, the rate's too high. Okay, so let me explain to you, when they start talking about net neutrality in rates and things like that, what are they actually talking about? Well, they're talking about the difference between this right here, what the Federal Reserve has tagged in as an interest rate, and right through here, inflation. Okay, usually these should be basically equal, because if inflation is eating up 2 or 3% of our dollar, well, then we're going to use 2 or 3% as our federal funds rate, or our inflationary rate, or target rates when it comes to interest rates. Okay, so we want these things to be basically net neutral. So if the PCE, which is inflation, is at 2.2, and the federal funds rate is 4.75 to 5, you see there's a lot of cutting that is still in the cards that they can do. Okay, so that's basically how the broad markets look at things. Well, the conundrum with this is this thing here. And a lot of people are just kicking this can down the street because the federal government is spending so much money and they have to issue Treasury bills to fund this thing. It's adding too much debt to our economy, which is adding too many bonds to our economy, which is competing against government bonds and mortgage bonds. And thus, interest rates are going to be higher for longer. And it's because of this is one of the pieces of the puzzle to that equation. Okay, so now let's get over to some of the issues we have in today's market. Well, one Fed official that came out today, Fed Daly, he comes out, and this is today, folks. He's saying on October 15th, maybe the Federal Reserve could actually skip a meeting or two and not do anything with rates. Okay, so now the markets are like, now what's going to happen? Okay, so again, we don't want uncertainty in the economy right now. So we go over to this, and now what we're trying to figure out is, what are we expecting? Because I'm trying to work on my 2025 kind of forecast or predictions, where rates going to go from here. And all these pieces of the puzzle are going to add to that equation of coming up with interest rates. Okay, so now is the Federal Reserve actually going to cut rates? No, I don't think so. And there's an interview right through here, and this guy has a pretty darn good argument. And it's basically the same argument that I would have. So let's let Becky take it away. And this is an economist on Wall Street. And again, the reason why I do this is I like to come up with my take on things. And then what I do is I go out there and, posts on from CNBC, Yahoo Finance, and things like that, interviews with people that are on Wall Street and in the know that should know these things and get their take on the markets right now. So let's get over to Becky. Let's see what this interview sounds like. And then I want to show you guys, is the CME FedWatch tool starting to change on this news? So is the Federal Reserve not going to change rates at the next meeting? To the interview.
Including what he's seeing from earnings and how the Fed has impacted things on Wall Street is Noah Blackstein. He's senior portfolio manager at Dynamic Funds. And why don't we talk first what you think the mood is for equities, and whether you think these highs can continue?
I think these highs can probably continue. I think we've got the Fed with probably 2 more rate cuts this year for sure. I think that credit is being well behaved. We'll see how the earnings season goes, but leading indicators from the banking stocks, certainly on earnings and on credit, would suggest that the economy looks fine. Since July, you've had much broader participation in the market than just 7 stocks. All of that's boding well, I think, overall for the market to continue to work here. Obviously, there's some geopolitics and perhaps concerns around the election, uncertainty. But from what we see outside of people trying to hedge equity risk, credit and bond markets have seemed relatively tame, and we think the market continued to work higher this year and into next.
Hey, Noah, there have been some questions that just start with the assumptions that you just listed. The idea that we definitely get 2 more Fed cuts. Fed Governor Waller making some comments that maybe we don't need to cut as much, that maybe the economy's in good shape and we don't need it. You just made the comment yourself that we are in good shape. So if the Fed comes around to that conclusion and does not do another 2 rate cuts, is that a problem from the equities perspective?
Yeah, I think they're going to do another 2 rate cuts. They're not going to skip a meeting. Look, you're going to have a jobs number that's, first of all, on the last jobs number that you had, the participation rate in terms of who filled out the survey was at a 10-year low, which suggests that it's highly probable that it's going to be revised. I think the downside risks to employment are certainly there, and real rates are very high. Whether you want to take the 6-month annualized inflation number at 2.6, or even you want to take the other 12-month inflation at 3%, when you're at 5% on Fed funds, 200 basis points of real rates would be considered very tight at any point in the last 30 years. So the Fed funds rate is tight, and there's not a lot of slack on the labor side. So I think they're going to go 2 more times. I think that jobs number was a head fake. Number one, two, the next amount of jobs data that you're going to get is going to be really messy because of the hurricane impacts that we've seen. So to err on the side of caution, I would suspect that they cut. You're also probably going to get a misread on retail sales on Thursday. I think they could come out stronger than expected because of all the stocking up on supplies that happened during the hurricane areas. And so, I think the data is going to be weak, and it's much better to err on the side of caution. The idea of skipping, I think, would have consequences for the bond and equity markets for sure.
Well, if you're worried about the bond and equity markets, that seems like a silly reason to go ahead and cut rates. If you are actually worried that the economy is struggling underneath it, that's a different story. You think the economy
I don't think the labor market. I don't believe that the labor market is as strong as that last report. Just given how low the response rate was on that survey, would suggest that it's highly likely it'll undergo significant revisions. Given that, and given how high real rates are, the Fed has thus far, I wouldn't say we've landed yet, but they've steered this fairly well, beginning to keep rates this high, though, as inflation continues to fall, is de facto tightening. The economy doesn't need them to do de facto tightening, as unemployment hovers around 4.2 on its way to 4.4. So I would suspect 2 more rate cuts of 25 basis points each as they put out in their forecasts.
I know, it's just real rates are at 4%, which doesn't seem excessively high if you are looking at the last 20 years.
For real rates?
Yeah, the 10-year at 4%.
Those are very high for real rates. 400, 300 basis points for real rates is very high in the last 30 years.
We won't go through there going back and forth and back and forth. You get the gist of it. What I was saying previously was when you have the federal funds rate, let's say at 5, and you have inflation, even if you take the high tune on that at 3, you still have 200 basis points, 2% higher in rate. So that's what he was saying. But Becky was saying, the normal rate. So don't get confused with it all. The Federal Reserve will continue to cut gradually. That's my perspective on this, and that'll be my forecast. We go over to the CME FedWatch tool. There's a 95% probability. Now they're going to do a 0.25% cut at the next meeting, and then a 0.25% cut at the next meeting, and then a 0.25% cut at the next meeting. And this is the chart right through here. So this is the CME FedWatch tool. If you haven't seen this before, you got to check it out. And you can just go to it. It says in 22 days, the Federal Reserve is going to do what? And then there's all this data down through here, basically giving you each meeting date down through here, and then where the federal funds rate is going to be through here. Just to clarify this, for example, the federal funds rate today is 4.75 to 5%. That's this tune right here. So it's 475, 500. It's not in a decimal place there. So you can see where there is basically a 5% chance the Fed's going to keep rates right where they are right now. So the next piece of this equation we want to talk about is if you're looking to buy a house, what are advisors telling you to do? We're just going to go to the top 3, and they're interesting. And these are the things that we tell you every day. And it actually, 2 of the 3 are things that we've started about a month or 2 ago. And I'll explain it to you, and you'll understand as we go down through. When you're looking to buy that first house, some of the things that you can control, okay? You can't control your wages. You can't control a lot of things. What can you control? One of the biggest things you can control is your credit score. Okay, a lot of people, it might be tough because you might have dug a huge hole. And so it took you 3-4 years to get in that hole. It's not going to take you 2 or 3 days to get out. So one of the biggest things you want to focus in on is your credit scores. Okay, there's tons of different areas where you can get your credit information. I actually created a website years ago. It's called creditscoresandmore.com. It looks just like this. You can visit it. And the reason why I did that is there's so much misinformation about credit scores. You probably don't even realize you have over 30 different credit scores. Okay, so when we talk to people as mortgage advisors, when we talk to people, one of the first questions we ask them is, what's your credit score? Everybody tells us it's like 740, 718. Then when you ask them what it is, most people don't have a clue what it is. So make sure you're educated, informed, and you have the right information when it comes to your credit scores. You need to get your FICO score. Okay, so that's why we use some of the systems we use on creditscoresandmore.com. There's a free systems. These systems don't use the FICO score. It's your Vantage score that's being used, and that's what most of the free systems are. If you really want your real credit score systems, your true FICO scores, you got to check out your true scores right there, and you get a discount if you use that system. I'm not really doing this to sell that piece, but that was one of the first things when it came to this. Okay, so now the next piece of this equation is you go down through, how much do you need to save? You're going to need money to save for the down payment and to save for an emergency fund. Now, in today's world, when you're buying your first house, the things have changed a lot this year. This year, there was a NAR settlement. It was basically a realtor's big lawsuit and settlement where in the past, if you were buying a home, you didn't directly, cut the check to pay the realtor to help you buy that house. Usually the buyer would cover that cost, and it was in the price of the home and everything else anyways. Nowadays, it's your responsibility to pay the agent that you're working with. Okay, a lot of people are still having the seller give you a credit and so forth to do that, but in most cases, you're going to need a little more money most likely in today's world when you're buying that first house. But it's a little different than when it used to be 10, 20, 30 years ago when you needed 20% down. Yeah, you used to need 20% down when you bought that first house. Now in today's market, if you're a veteran, you get away with 0% down. If you're buying in a rural area, you can get a 0% down. If you're a first-time home buyer in just standard mortgage programs, you only need to put 3% down. If you're buying, an investment property or so forth, in most cases, you need about 20% down, but that's mostly the only time you need that. And the next thing is, boosting that emergency savings. Buying your first house isn't just, covering that down payment and moving in. You're going to need a lot of things. You might even need, you're going to have to turn on appliances. You might need security deposits for that and so much more. So I've been trying to educate you guys on, how to invest, where to put your money and so forth. So we're going to continue on that. I'm going to post something on our YouTube live today to see if you wanted me to talk about ETFs, or if you want me to talk about maybe internet stocks, or if you want me to talk about cryptocurrency. So check your vote there. We might even do a live event to see, what questions do you guys have when it comes to that. So my name is Dan Frio. I do this report every day. Right now, our website is getting a little bit revamped. It was old, it was kind of laggy, and we wanted a little bit of a fresher start. So we're using Kyle's website at the moment. So Kyle Seagraves of Win the House You Love, he's on our team as well. So you can come to his website, which is Win the House You Love. You can do a whole bunch of things right up through here. One of the tools he has that's fantastic right through here is you can find some grants that we're offering. So it's a grant finder right there. Check that out. That has national grants that you can find. Or if you're in Illinois, check out and see if you're available for the Illinois grant right through there. But check out all this stuff. And if you want to get started on buying maybe that, seeing if you can qualify to buy that first house, maybe first investment property, maybe if you're looking to refinance, get started, all you got to do is click get pre-qualified right now. The cool thing about this is you can click that. You can even go down through here and even ask us questions along the way. But then you're going to schedule an appointment so you can ask all your questions to me, Kyle, or one of our mortgage advisors one-on-one. Make sure your answers are your questions are answered. So thanks so much for watching today. God bless you. Hope you had a fantastic day. If you haven't subscribed to my channel yet, please do so. I'm trying to get to 32,000 subscribers as quick as we can. You can help us get there. So thanks so much for watching. I'll be back tomorrow morning at the opening bell. Take care.